Hi, everyone. As you are filtering in here, I'll go ahead and do a quick introduction for myself. I just wanted to make sure my video is on so everyone could see my hat here. Happy holidays. Thanks for joining us for the last webinar of the year. But yeah, before we get started, I'm going to go over some housekeeping items, do some introductions, and then we will go ahead and get started. So first and foremost, if you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. We will need you to answer our poll questions as they pop up on your screen. If you have any issues with that, please just send me a message. I'll help you get that sorted out. We also will need you to fill out the survey at the end of this webinar. That should pop up for you automatically as you are leaving. If you have any issues with that, just let us know again, and it will also be emailed to you in 24 hours. So you should have a couple ways to get your hands on the survey. So a couple other housekeeping items here. If you have questions as we're going along, please reach out and ask those questions. We're going to do our best to address them at the end of this webinar or following up with you via email. Again, you can use that Q&A button in the middle of your screen to ask those questions. And thank you for the cool hat comments. I appreciate it. But again, use the Q&A button, ask those questions. We're going to do our best to address them either during the webinar or afterwards. We also will be linking today's slides and handouts in the chat box once we get started here, so you can keep an eye out for them there. We also will be uploading them directly to Zoom and emailing them to you again in 24 hours. So you should have a few ways to get your hands on the slides. And let's do some introductions here. Quick introduction for Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to your estate tax and related needs. So we do a lot of consultations, research, registrations, sales tax returns, sales tax audits, and more, just like our name states. So again, if you have questions about our services or you would like to work with us, please reach out and let us know. We would love to work with you as well. And a quick introduction for our founder, Michael Fleming. Mike's tax knowledge is very well-rounded, and he has helped thousands of companies of all sizes and in all industries, and is especially well known for his work in the commerce industry. And Mike, if you want to take it from here, let's go ahead and get started.
Thank you very much. Having a tough time getting started already. I think it's the hat envy. I'm very envious of your hat there, Ellie. I now wish I had one. A lot of information to go over today. We're going to get started with the end of the year wrap up. And this is a great time of year to be talking about some of the things we're going to be talking about today, because a lot of the states are basing their economic thresholds based on the prior year. So every January or every December around this time, companies should be looking at their data for the last year and see if they've crossed any thresholds, if there are any new states they can get registered in, or perhaps states they can deregister in. You know, some of these states have a 1-year trailing nexus threshold, so you may or may not be able to do that, but that is something that you want to look at. Where do you need to get registered? Where can you get deregistered? And even the states that don't say previous calendar year, those are the easy states. You check every January, and if you're not over the threshold, you wait until the following January to do anything. But some states say previous year or current calendar year. So that can be important. You know, if you're over it in the last 12 months, then you go ahead and get registered now. But maybe you're not. And as you go into the beginning of the year, maybe something's changed in your business. We had one client who ended up going on Shark Tank, and their business virtually exploded. And I was reviewing their data for the previous year, and this was in March, by the way. And the had to get registered in like one state. In they weren't registered. They only registered in like 3 or 4 states to begin with. They got registered in another 1 or 2 states, or they would have had to. But then the salesperson let me know that their sales had exploded. And I said, okay, well, we need to review year-to-date sales as well as previous years. And the year-to-date sales were up so much that they had to get registered in another 18 states or so. And, altogether, they're registered 22 states or right around there. So if your sales are growing on a normal curve, then perhaps you don't have to do anything until next January anyway. But if something's changed, if your sales are really exploding, then you're going to have to check it a couple times through the year. But January, very, very important, because states say either previous year or current year or prior 12 months. So January, the end of December is the time when we really want to start looking at this. And like I said earlier, we can also be looking for states where we can deregister. I want to talk about physical nexus because, a lot of times companies think that, oh, now that we have economic nexus, we don't have to worry about physical nexus. And although the Supreme Court said you don't need a physical presence in order to create nexus, a physical presence still does create nexus. And as these states, ramp up, I think we're going to see a ramp up, and we're going to talk about this in a minute, their audit and discovery efforts. I think that's where the real exposure is going to lie. Yes, economic nexus, a lot of companies are not compliant for that now, but that's only 4.5 years old, where you could have had physical nexus for the last 10 years in a state. So we all have to, at this time of year, good time of year, to look back at our activities in the states and see if we have crossed any of the thresholds, as well as just having activities that create a physical presence there. Also, this time of year, I know a lot of companies out there that do budgets. A lot of times, if you don't use your budget, then you don't get as much the following year. So this is a great time of year, even this late into the month, for companies that have unspent budget to get them taken care of. So no matter who you're working with out there, sometimes it's good to get the money spent in this year, even if the projects drag on into next year. So those are the few of the things. Here are some of the specifics I want to talk about. Missouri's economic nexus, it becomes effective on January 1st. So if you had $100,000 in sales this year, and by the way, those sales are limited to tangible personal property. So it's not like some states where you count services and digital goods. It's actually tangible personal property. If you're over $100,000 this year, then on the 1st of January, you should be collecting sales tax. By the way, there are no transaction thresholds in Missouri. And the sales of the tangible personal property, the way I'm reading it, and they just put out a frequently asked questions, it looks like it includes all marketplace sales, all exempt sales, and all sales for resale. It's all sales of tangible personal property. All right, so something else I want to talk about is Kentucky, because beginning January 1st, 2023, they're going to be taxing a lot more services, and many services that were previously exempt in 2018. That's the last time they came out and started taxing services. They started taxing a lot of services in 2018. Many of the services that were exempt in 2018 between then and now are now taxable. So some examples are general facilities, rentals, instructional and training services. They were exempt as educational, no more. So you don't get an educational exemption for a lot of these instructional or training services, whether they're live or whether they are recorded. And interior design is now going to be a taxable service. In the past, interior design, they were generally the final consumer. They didn't tax their clients. They just paid the tax on the items they purchased. No longer. All of that is going to be taxable to the clients. So looks like we've got an issue on this slide here. That last bullet point doesn't apply. However, one thing I want to talk about here is we've got a handout. It's from the state of Kentucky, and we're going to get that out to you, and it's going to be up on our website also. Sorry if you're hearing my dog barking in the background. He's the newest addition to our puppy family. He's a Great Pyrenees, and he's about 100 pounds and 7 months old. So he's got a big dog bark. Anyway, getting back to Kentucky, they're not the only company that is taxing more services. I say this all the time. Every year we have more and more states tax more and more services, yet I still hear people saying services are not taxable. And there's going to be an even bigger push going forward. I mean, back, historically, we've been a manufacturing-based economy, but, for the last, I don't know, decade or so, we've really been more of a service-based economy, maybe even longer than a decade. I just pulled that number out of thin air. So the states, they've got to play catch up because the greater percentage of the companies in their states are doing services. So they don't want to lose out on all of this revenue. So we're seeing a bigger push. Every year, more and more states are adding more and more services as taxable services. As we go into the new year, the first 6 months of the year are usually the legislative season, and we're going to see lots of crazy things come out there. Some of them never come to pass, but some of them do. So expect to see that. They usually become effective in July or the first of the year, but we get the news earlier. So that's something to watch as we go into the new year. Now, here's something else. Exemption certificates. And I think Ellie got a little bit creative in the pictures she's using here. The end of the year wrap up looks like we have some nice wraps on the side there. But exemption certificates continue to be a major audit issue. And even companies who think they have it under control are getting hurt. Exemption certificates, it used to be a matter of substance over form. In other words, if the auditor could tell that it was an exempt certificate, you got a lot of leeway, but not so much anymore. Now it's rather form over substance, and every T has to be crossed and every I has to be crossed also. And this is one of the biggest issues when it comes to audits. These are what the largest assessments are based upon. So you want to make sure that your certificates are going to survive an auditor's inspection. And, even one missing certificate can have a huge impact. So I talk about this all the time. If you've listened to me before, exemption certificates, we were doing an audit, and it was a Texas audit, and we became involved after the audit was over, and it was in the redetermination period. You have 60 days to perfect your certificates, and this was about a $3.5 million audit. 60% of it was related to certificates, and we got asked to help out on this portion of the audit, and we got all the certificates except for one, and there were some tough certificates in there to get. We did great on the rest of the audit too. We got it down to about $17,000 from $3.5 million, except for this one certificate. And we tried to get it detailed out of the sample, and the state of Texas would not allow us. They made it stay in the sample because of all the other favors and everything else that we got done in this audit. And this invoice it should have had about $8,000 worth of tax on it. So that's a lot of tax on one invoice. It was a heavy piece of earth moving equipment, and they sold it to an individual. And we looked everywhere and we couldn't find this individual anywhere. We even, used skip tracing companies to try to find this. The company did the same thing. No one could find this individual. They disappeared off the face of the earth. So no one wants to pay $8,000 worth of tax. However, because audits are usually done on a sample basis nowadays, it's not just the tax on that one invoice that you have to worry about. When it's extrapolated out over the population, this one invoice, it was close to a $270,000 issue. So add that to the 17,000, we're just under 300,000. The client's still happy with 10% of less than 10% of the original amount. However, one certificate, $270,000 issue. And it's because of that sampling that companies have a lot of problems. I mean, we do a lot of exemption certificate management, and we'll tell, a company, hey, this certificate should be, rejected. And for whatever reason, smaller companies, the owner says, this is one of our best clients and we can't do this. And, or the salesperson kicks up a fuss and says, hey, we have to accept this certificate. And they do this, on a number of times. And I've got to call them and say, hey, do you realize it's not just this one certificate when you make an exception that this should be rejected? If you get audited, this is extrapolated out over the population. Certificates have an outsized impact on audit assessments, and they generally don't realize it. So all of a sudden, they go from, making exceptions on everything to making exceptions on nothing. So sometimes, it's someone in the know who's making these exceptions. Sometimes it's policies not being followed. I mean, you can have a great policy. However, if your people are not enforcing it, if they're not doing it, which we see a number of times, that's an issue. Or some companies have no problem, policy. They don't even collect certificates. So all of these are major issues. And that's why, the certificates continue to be a major problem in audits. So if you're not managing these right now, we suggest that you put some sort of policy together. If you need help with that, there are lots of companies that do it. A big part of our business is exemption certificate management. But somebody's got to be making sure it's not enough just collecting the certificates. It's making sure they survive an audit. We call that certificate validation. And like I said, companies think that they have this under control, and then they get audited and they get hurt. So this is a great time of year to do a spot check. We've got a service out there. It's called, exemption certificate spot check. So it's not hard to remember that one, but we can look at any number of certificates, as little as 25, and see if they would actually survive an audit. And if they would, then that gives you a little bit of peace of mind. But if it doesn't, then maybe you need to do some work before a state finds you. Now, use tax is also a major issue. It's use tax and certificates, two of the largest reasons for large assessments in an audit. And it's hard for many companies to track. And, sometimes it's a lack of knowledge. The people who are actually responsible for this, there's a lot of turnover in those departments. So as soon as someone gets it all down, you got to train a new person. Those people often don't have the resources they need. They don't have the knowledge. I'll give you a little bit of auditor humor here. Manufacturers, they don't pay tax on a lot of things, but things that are usually used or consumed in the manufacturing process. So there was this one company, and they had a central purchasing location, but they were purchasing for all of their offices all over the country. And the auditor came to me, and they had hundreds of thousands of dollars of toilet paper exposure. It was actually millions of dollars purchases. The tax over this period were hundreds of thousands of dollars. And he came to me and he was laughing. And he said, Mike, toilet paper is used and consumed, but it's not used and consumed in the manufacturing process. And he had a big chuckle about that. And what was happening here is this woman thought that she was saving the company money because all of these, purchases had tax on it. And she believed that manufacturing companies didn't pay tax on any of their purchases. So imagine having to go to your boss and let him know and say, hey, I thought I was saving the company money, and I cost us, quite a bit here because of all the penalty and interest. As well as the back tax for that toilet paper. And that's an isolated, that's not an isolated example, is what I'm trying to say. We see that type of issue coming up and over again, which is why use tax is so tough. A trend we've been seeing lately is the over-reliance on the claims some software companies make. I mean, the software company says, oh, just pay for our software and you won't have to worry about use tax at all. The problem is you've got to make major changes to the way that you're, doing your accounting and in order to use their software. So you got to be careful. Software is generally good for software, and it may help in your process, but it's not going to solve all of your problems. And most of them, it could just make things tougher on you. So there is a standout solution. There's a new company out there, and it's Ceratax, well, relatively new. And Ceratax, the reason why I like this company, the reason why they caught my attention is because they stick to software. They don't try to get involved in services. And software companies are just that. They're software companies that happen to be in the sales tax business, but they're not sales tax companies. And, for the companies that are relying on software companies for services, they often find out that 2-3 years into this, they've made a big mistake. So be careful of who you have performing your services. This Ceratax, it's software, pure software. They don't offer solutions, and they're head and shoulders above where everyone else is at this point. If you want more information on Ceratax, we can provide it, but also you could go directly to their website. We're probably going to be looking at working with them a lot more going forward here because I think they are so different and they're so far ahead in their technology from where these other software companies are at this point. All right, so audits and discovery efforts. No one wants to hear this, but when revenue dips, efforts usually increase. And as we head into 2023, money that was provided as part of the pandemic relief, it's mostly gone. So, when their revenues took a little bit of a hit during the pandemic shutdowns, we had a couple of things working in their favor. Number one, this economic nexus, the results of the Wayfair case had a lot of new revenue coming in from online sales, so that was good. And then the federal government gave a lot of handouts to help these states during the time of the relief, and all of that's gone right now. And based upon the historic definition of a recession, we'd be in one right now, even though most of the indicators are still positive, I think that's going to be changing. I think that 2023 is going to be a tough year. I think we're going to have stubbornly high inflation. And we've already started seeing the layoffs, retail sales disappointed this morning. So I think 2023 is going to be a tougher year than many are thinking. And when we start talking about recession, sales tax dries up, there are less sales, income tax and other types of taxes and fees start to dry up at a time when the state's need for cash usually rises. I mean, they got to pay out more unemployment benefits just for one issue here. They need to help, people who are having trouble feeding their families. So there's a need for cash. And historically, what they've done is increase their audits and increase the discovery activity. And discovery activity is each state has a discovery unit that looks for taxpayers that they think should be paying tax in their state who are not. So those are two activities that are usually increased when we do have an issue. So let's get that's just some of the things I think that companies and individuals need to be thinking about as we head into the new year. Now let's talk about the worst time to find out you have problems. We say this every webinar. Once the state contacts you, and it can be by mail, can be by phone, maybe they send you a Nexus questionnaire, could be by email. But once they contact you, your options are limited as to how you can protect yourself from past liabilities. Right now, if you're being proactive, there are a number of different steps you can take to protect against or limit your exposure to some of these past liabilities. But once the state reaches out, in most instances, there are some exceptions like Michigan, but in most instances, some of your most potent options are off the table. All right, Ellie, why don't we go to the first polling question here?
Yeah, absolutely. Can you, I just switched my microphone. Can you hear me okay?
I can hear you okay.
All right, so that first question should be up on everyone's screen. We want to know, how would you rate your Nexus knowledge? Your choices are, what's Nexus? You know the basics, you have an intermediary knowledge, or you are an expert, a Nexus expert. So we'll give everyone a few more seconds here to answer these poll questions. You do have to answer them in order to receive CPE credit. And Mike, why don't we, in the meantime, get your camera off? Your video quality is lagging, but your audio seems to be pretty good. So let's in this poll, we have a really good mix in the crowd today, intermediate, beginners, and some experts out there. So I'm going to close this and let's move forward.
All right, thank you for that, Ellie. And let's start with the definition of Nexus. And Nexus is just a fancy word, and it means link or connection. And when we're talking about taxes, it's the link or connection that must be present before a state can require you to do anything. For example, before a state can ask you to collect a sales or a vendor's use tax, or pay its taxes like an income tax, a franchise tax, or a consumer's use tax, you've got to have some sort of link or connection with that state. And we call this link or connection Nexus. Now, that's why we say it all starts with Nexus. Because if you don't have this link or connection, then the state can't require you to do anything. So that means no problems and no responsibility. The real issue is, though, is that a lot of us don't know what our Nexus footprint is, or our advisors may not even know what our Nexus footprint is. So that's what we're going to talk about today. And let's go to the court. I want to talk about some court cases that have an impact on Nexus. In the first one here, By the way, these are all U.S. Supreme Court cases. So National Geographic versus the Board of Equalization. This was a 1977 case. It was out of California. And the takeaway from this case was the taxable activity does not have to relate to the nexus creating activity. And I think this is really important right now because, during the pandemic, a lot of companies that only sold on a wholesale basis or sold to brick and mortar stores have now gone directly to the internet, and they're selling directly to the consumer. And I've spoken to a lot of these companies, and a lot of times they say, well, we're not going to worry about the getting registered in these states because we're not anywhere near the thresholds. We're just starting this activity out. However, the nexus creating activity here is this network of wholesale reps they have, or employees, or manufacturers reps, because that's the nexus creating activity. And these companies didn't worry about it because they didn't have any taxable sales. But now, when they start selling directly to the consumer on the internet, they have nexus from sale number one. And a state like Texas has a $500,000 threshold. They're waiting until they reach that. And unfortunately, now you get $500,000 of sales where you didn't collect the tax, and that comes out of your pocket. So very important case here. Something else, some states are doing away with this, Pennsylvania, but Amazon will often create a nexus, have an inventory in that Amazon warehouse. California is a big believer in this, and they're going after companies. But having inventory in an Amazon warehouse, even though Amazon is collecting and paying the taxes, you still have nexus. So maybe your Shopify sales, you're underneath $500,000 when combined with your Amazon sales. So you're thinking you don't have nexus in California, but the inventory creates that nexus for you, and it does it not only for the sales tax, but also for their income tax. So you got to be careful. This is a very important case right now. Reminds us that the taxable activity does not have to relate to the nexus creating activity. Complete auto transit. I think this is an important case, especially when we have a lot of online sellers here. A lot of online sellers think that only Congress can be involved in interstate commerce. And if we go back to the 1930s, that's when the first modern day sales tax came about. That was true. Even the states didn't believe you could tax interstate commerce, but that started changing in the 1950s. And in 1977, we had the Supreme Court, they didn't come up with anything new. They just sort of looked at all these cases that happened since the 50s. They cobbled them all together, and they said, yes, a state can tax interstate commerce directly, so long as it meets a four-pronged test. And it's a fairly easy to meet four-pronged test. And is there a substantial nexus? Is it fairly apportioned? Is it discriminatory? Is it fairly related to the services provided by the taxing jurisdiction? I want to say something about, is it fairly apportioned? Because there's two parts of that. There's internal consistency and external consistency. And in internal consistency, it talks about double taxation. And it doesn't say that double taxation is unconstitutional. What it says is that if every company had the same exact, if every state had the same exact rules, and there would be double taxation, then it would be unconstitutional. However, the thing is, not every state has the same exact rules. So if there's double taxation because states have different rules, that's not unconstitutional. It's only that if you said, okay, here's our state, and if every other state had the same exact rules and there was double taxation, that would be unconstitutional. So this is a fairly easy rule or test that to be passed. And double taxation. A lot of companies tell me, well, Mike, that's double taxation. That's unconstitutional. No, it's not. It's only unconstitutional in that situation that I just talked about. All right. So next two cases, really, really important. And these are the cases that dealt with physical presence. Excuse me. These are the cases that dealt with attributional nexus or agency nexus, or what we call third-party nexus. So when we're talking about physical presence, these are some of the most important cases, I believe. Scripto was a 1960 case, and it was Scripto was the company located in Georgia. They had 10 independent sales reps in Florida. And Florida said, hey, we think that these 10 independent sales reps that you have in Florida create enough of a significant nexus that you need to collect our taxes. And Scripto said, you're out of your mind. How we don't control these people. They're true third parties. How in the world can that create nexus for us? Well, it goes to the Supreme Court. The Supreme Court says that the difference between an employee and an independent contractor is without consistent constitutional significance. They're both doing the same job. So that's the beginning of what some people call attributional nexus, agency nexus. I simplify it. I call it third-party nexus. We see this issue go back to the court 27 years later. So 1987, Tyler Pipe, it's a Texas company. The state of Washington says, hey, according to Scripto, you should be paying our business and occupation tax. And Tyler Pipe, a Texas company, says, you're out of your mind. No, this is not like Scripto at all. This is only one person, and they represent multiple parties. In Scripto, they represented Scripto only. So they're representing multiple parties here. And, I'm going to paraphrase what the court said. In the beginning, the second part is the most important part here. They said it doesn't matter what you call someone, doesn't matter what you pay them, doesn't matter if they do it on a full or part-time basis, doesn't matter whether they represent you or whether they represent multiple parties. Here's what's important. Are they helping to establish or maintain a market? And if they are, that can create nexus. So this perhaps is the biggest issue I see companies having when it comes to nexus. And while the states are going to come looking for economic nexus because 1 and 2 companies are not compliant right now, they're going to stumble across all types of nexus. And this is something that you could have had for 8, 10, 15 years because it just doesn't make sense. When we're thinking about what creates nexus for us, we're usually looking at the activities that we or our employees are doing. We're not generally thinking about what a third party is doing for us. And we're going to talk about this more later, but this is the biggest issue out there when it comes to nexus, in my opinion. All right, in the last case, one of the reasons why we're all here is South Dakota versus Wayfair, and this overturned all of the cases that the Supreme Court had previously said that physical presence was required. And the Supreme Court at this time, they did something that was fairly unique. They said that they were wrong. They didn't say times have changed or whatever else. They said we were wrong. We never should have introduced the concept of physical presence to begin with. And, that means that states could go back to the date of 1967, the National Bill Assess case. But South Dakota was fairly smart. They said, we're only going to do this on a going forward basis. And, this ushered in economic nexus where no physical presence is required. It can be based on sales. It can be based on transactions. South Dakota thought $100,000 or 200 transactions was fair. The U.S. Supreme Court didn't explicitly agree with that, but they sort of gave South Dakota a wink and a nod. They did send it back to the lower court to be settled. However, that case was settled before they addressed this issue. So we may see some further litigation on this, but I don't think we're going to see too much on this particular issue because the states have implemented this on the most part fairly reasonably. Now, there are states like Illinois that had a problem that I don't think they meet the four-pronged test because they have different rules for in-state sellers versus out-of-state sellers. That's discriminatory. So something like that we may see challenged, but for the most part, and the home rule states, the Louisianas, the Colorados, but for the most part, the states have implemented this very well. So I don't think we're going to see too much litigation on this in general. On some very specific issues, yes. All right, so when we're talking about economic nexus, 2 points I want to make. Number one, it doesn't protect you from any other type of nexus. As a matter of fact, a physical presence is almost always going to trump an economic nexus. Yet every week we have someone who contacts us, either a current client or a prospective client, and they say, I don't want to be registered in Texas or California. You know, those are two of the big states. They have $500,000 thresholds, no transaction thresholds. And I'll ask them, well, why don't you want to be registered there? And they said, well, I'm below the threshold. I don't make $500,000 of sales. And I'll ask a question, if it's a previous client, like, well, you used to have an independent contractor traveling into the state. Oh, yeah, I still have that, but I'm underneath the $500,000 threshold. Or in California, I'll ask, hey, last time we spoke, you had inventory in the warehouses in California. Oh, well, I still have that. Only I'm underneath the $500,000. And at that point, I got to break it to them. It doesn't work that way. A physical presence is always, at least for sales tax purposes and other types of tax, income tax, for example, not so much. But when it comes to sales tax, the physical presence is almost always going to override the economic nexus. So it doesn't protect you. It just gives the states one more way to get you to do what they want you to do, which is collect and pay their tax. All right, so the next issue is this is not an internet tax. And I still hear so many people, some smart people, some, CPAs out there are referring to this as an internet tax. This is not even an internet issue. It's a multi-state issue. You don't even have to have a website in order for economic nexus to impact you. Let's say you're selling entirely over the telephone, or you're selling entirely by referral, or you're selling by infomercial, or you're selling by catalog. It doesn't matter how you sell. If you're selling into multiple states, this is a potential issue for you. A lot of states out there, a lot of companies out there, these software companies are going to tell you they've got the best thing since sliced bread, and it's going to tell you exactly where you have nexus. Shopify's got it. I mean, everybody's got something right now. The problem is you can't live and die by what the software companies are telling you, or Shopify's telling you, or whoever's telling you this, because this is so granular. They generally give you the wrong answers, or I shouldn't say that. They can often give you the wrong answers because they're speaking in generalities. They don't know your fact pattern, because some states include marketplace sales, some states exclude marketplace sales, some states include exempt sales, some states exclude them, some states include exempt sales except for sales for resale. So there's so much granularity here. I have not yet seen any software that does this well. Now, what that software does, it acts as a red flag. It draws your attention to the issue and say, hey, I should check on this. But then you need a chart like this, and this is something Ellie's going to hand out. It's also up on our free website. You got to look at it before you go out, run out and get registered and say, okay, does this actually apply to me? Does it fit my fact pattern? And a lot of times I see companies getting registered in too many states when they don't have to, but it works the other way too. Sometimes not enough states because they don't run all of their sales through this engine, this software that tells you where your nexus is. So if you exclude your wholesale sales and it's a state that actually includes them, then you're not getting registered in enough states. So this chart will tell you what the monetary threshold is, what the transaction threshold is, what's included, what's excluded from those thresholds. The calculation methodology, is it previous calendar year only, like Alabama? So you should be checking Alabama right now and see if you're over that $250,000 threshold. And if not, you don't have to worry about it till next January. Florida is the same way. However, you see Arkansas, Arizona, and California, it's the previous calendar year. So you need to be checking it right now or the current calendar year. So depending on how quickly your sales are growing, you may have to check it once or twice during the coming year. Or if they're, just growing at a 2 to 3% rate, maybe you don't check it again until next January anyway. So this chart has a lot of information on it, and it's just been updated. The most recent version is out on our website. And before you just run out blindly and get registered everywhere that a software company tells you to, I suggest using something like this, or having a company do some sort of nexus review for you. For economic nexus, we have what we call a data review. We look at the last year's, right now, last year, as we get into March or so, we'll look for last year and year-to-date information and come back with recommendations on where you need to be registered. And, here's the commercial part of this. It's relatively cheap. It's $795. So we'll tell you where you have the nexus or where you don't and what you need to do. So that's something end of the year is a tool that could be very valuable to you. All right, so after the fact, this used to be say what's new, but some of this is old, but some people still have not heard this. So we moved it. These are things that have happened after state has announced their thresholds or after the majority of the states have put something out there. So these were the last 3 holdout states in 2021. They all passed something. Florida, they passed their economic nexus and marketplace facilitated statutes. Florida is a state that looks back to the previous calendar year only, and it's $100,000, and there are no transactions. That became effective in 7/1 of 2021. Kansas, they impose pretty much the same exact thing as Florida with one difference. They say not only, do you have to look at the previous year, but you have to look at the current year also. And Missouri, we talked about that earlier. They passed it back in 2021. However, it didn't become effective until, or doesn't become effective until January 1st of 2023. All right, so after the fact, there's been a trend away from transactions. So Wisconsin dropped the transaction threshold. So now it's just $100,000. It used to be $100,000 or 200 transactions. They did that on February 20th of 2021. Arizona, this was planned when they came out. They started at $200,000 and they dropped to 150. And, in January of 2021, they dropped to 100,000. We still see companies out there that are looking at that original $200,000 number. This is not something you set and forget. It's something that you really need to be checking, every December or every January, so that you're not accruing any exposure out there. We call that the greatest tragedy in sales tax. I mean, something that could have come out of your customer's pocket at the point of sale, that's now coming out of your pocket with the added insult of penalty or interest. And it's real easy to avoid that tragedy if we stay on top of our Nexus footprint. So Tennessee, they actually dropped theirs because of the pandemic. They thought that their revenues were going to crater. They were at $500,000. There is no transaction threshold there, so they dropped to $100,000. Alaska, a lot of people think of Alaska as one of the nomad states. Nomad states are the states that don't, 5 states that don't have a sales tax. We've written about this, nomad no more, because all of the states have some sort of tax that looks or feels like a sales or use tax. Alaska actually has a lot of local sales taxes. So although there's no state level sales tax, the local jurisdictions have gotten together, formed what's called the Alaska Municipal League, and they administer the taxes for all these local jurisdictions. And if you past $100,000 or 200 transactions in Alaska, you've got Nexus. And then there's Maine. Maine dropped their threshold in January of this year. Their threshold, their transaction threshold. So now it's just $100,000. No longer 200 transactions get you Nexus in the state of Maine. All right, so Pennsylvania, they were sending notices to those with inventory in Pennsylvania, Amazon inventory. Now, they offered special VDA, and they said they're going to be going out, and it was really targeted against Amazon. And some Amazon sellers got together, and they went to court, and the court ruled against Pennsylvania. They said that, hey, inventorying an Amazon warehouse in our state does not create Nexus. Now, the state didn't fight that. They said they were going to address it other ways. The Online Municipal Guild, the spokesman, he's also an attorney for the Online Municipal Guild. He came out and said, yeah, we don't expect Pennsylvania to back away from this issue anytime soon. They may call it something else, but they're going to continue to do, I think he used the term bonehead tactics in order to try to get this done. So this one's in a state of flux. We're going to keep our eye on it and see what happens here. But this is an issue for income tax also. And although the court said inventory in an Amazon warehouse, if you're using other warehouses in Pennsylvania, this is still an issue for you. All right, so Illinois, remote sellers must collect destination tax based on the local jurisdiction as of 1/1/2021. And this is a nightmare because there's almost 4,000 jurisdictions. We've had to hire 3 new people just to handle the sales tax returns for Illinois. It's a very manual process. The software that we utilize doesn't take care of this. It's not been updated yet. So this is what I started to say earlier. Illinois is running afoul of the 4-pronged test, because if you're a remote seller, you have nothing in the state of Illinois, you got to be destination based retailer's occupation tax. But let's say you've got a warehouse in Illinois and you're making deliveries. Well, now you're retailer's occupation tax, but you're origin based. So if you've got something in state there, you get a much better deal than the remote sellers. So that's discriminatory in my opinion here. I think there is going to be a constitutional challenge there. By the way, it gets even more complicated. If you have a physical presence, maybe you've got a salesperson that travels into the state, that's still a physical presence. However, now you don't have to collect any of the local taxes. You just collect the retailer's use tax in Illinois. So Illinois is a mess right now. We'll keep you updated as to what happens there. In Colorado, self-administered local jurisdictions now require collection and remittance. They have the SUTS software in Colorado, which doesn't exactly work too well right now, but the goal of it is that you can have 1 point to get registered in all the local jurisdictions, and you can file your returns through the SUTS system. Still lots of problems with it, but the local jurisdictions are reaching out and they are going after, taxpayers who they believe should be paying them taxes. All right, so we talked about Illinois here already. This we've touched on, trend away from transactions, California, Colorado, Iowa, North Dakota, Washington, Wisconsin, and Maine eliminated their transaction thresholds. And these states, Alabama, Arizona, Florida, the rest of them written up there, including the three latest, Florida, Kansas, and Missouri, they have no transaction thresholds whatsoever. And Connecticut and New York don't have any standalone transactions. So if a state does have transaction threshold, they usually use the word or. So it's $100,000 or 200 transactions, but not Connecticut and New York. Connecticut and New York use the word and. So in Connecticut, it's $100,000 and 200 transactions. In New York, it's $500,000 and 100 transactions. So it's important to make this note. Even though there's a trend away from transactions, and I think transactions are not fair. It's, if you're selling a $5 item, you sell 200 of them, that's $1,000 in revenue, and you're treated as the same as someone having $100,000 in revenue. So I just don't think this is a good thing. I think this is a positive trend, but as soon as I say there's a trend away from transactions, everyone stops counting transactions. You can't do that because there's some very big states like Illinois and New Jersey that still have that 200 transactions. As a matter of fact, about 45% of all of the states still have a transaction threshold. So you can't automatically just disregard transactions. You're going to get yourself in trouble or your clients in trouble. You got to actually follow a chart like I shared with you earlier to see whether there is a transaction threshold or not. And by the way, South Dakota was pretty smart. They said that we're going to only do the economic nexus from the effective date. In other words, we're going to do this prospective enforcement. And at that point, no company had exposure for economic nexus because the states followed South Dakota. They said they're only going to do this going forward. But that's from the effective date. And these effective dates are getting old. New York says, I think it's June 21st of 2018. Next group is July 1st of 2018. So those are, 4.5 years old right now. So what are we waiting for? We're procrastinating. Well, in talking to people, we hear that think that Congress is going to step in. Well, Congress can't even decide to have something for lunch at this point. Congress, just to give you an example of how long it takes them to act on some issues, back in 1959, there was a U.S. Supreme Court case called Northwestern Cement, and it pretty much said that states could tax, interstate income any way that they wanted. And Congress got all up in arms, and business got all up in arms, and Congress passed Public Law 86-272 within 7 months of this Supreme Court decision, and it pretty much quashed the Supreme Court decision. So what it said is that if your only activity in a state is the solicitation of tangible personal property, and the orders are fulfilled from a point outside the state, and they're approved outside the state, state, then the state cannot impose a net income tax on you. But when they passed that, they said Nexus is so complex and so confusing that this is a temporary solution. We have to form panels and do studies and get commissions together so we can get a permanent solution. And here we are coming up on 64 years later, and we still have this temporary antiquated solution. So if you're waiting on Congress to act, maybe your great grandchildren will get some benefit out of Congress acting, but I doubt whether we're going to see anytime soon. If we do, I'll be pleasantly surprised. But I don't think that we can wait on Congress stepping in. And another thing is, people said, well, the litigation on this is not over. And they're probably right. It's probably not over. But it's mostly over. And all of the, economic nexus is here to stay. It may need some tweaks in a couple of states, but it is not going away. So my question is, why are we procrastinating? Two surveys, I already told you about one. It says 50% of companies are not compliant. The other one says 60% of companies are not compliant for economic nexus. And the states are getting more and more aggressive. Illinois, Maine, and Wisconsin, they're actually auditing everybody for once you get registered, they're going to come back and make sure that you use the correct date. South Dakota is actually stopping you during the registration process and saying, hey, are you sure this is the right date? So we see Alabama, Kentucky, notices starting to go out. Utah is calling people that purchased a list. So there is more and more aggressiveness in these states. So what are we waiting for? All right. So by the way, not every threshold is economic nexus. We've got cookie nexus, which the MTC is talking about again. On the income tax side, Massachusetts is keeping their cookie nexus alive. They are not rolling over and playing dead on that issue because they lost a court case, but they're still moving forward. Click-through or affiliate nexus, that's where we have, now it started with New York. New York said, hey, if in Tyler Pipe, you had one independent contractor sending business to a company and they were getting paid a commission on it, is a whole state full of people steering you business and getting paid for some type of referral fee or commission? Is that not a lot worse than one independent contractor? And the state of New York said, yeah, we think so. And it never went to the US Supreme Court. So you had about 21 companies or so follow through with this click-through affiliate nexus. They call it click-through nexus because it was generally done with a link. There was a link that took you from your website to, say, Amazon's website. And if you purchase something within 60 days of using that link, the company that had the link on their website got paid. So that's why they called it click-through. But this is really any type of referral. If you're paying someone for referrals, then it would fall under this, also under other issues. But the third thing here is notice and reporting requirements. And by the way, let's forward this. Here's Cookie Nexus. If you want more information on it, here's more information on the click-through nexus. We've spoken about those. Use text notice and reporting, I want to spend some time on here. And what this is, it was started by Colorado back in 2010. And I thought that Colorado was absolutely out of their minds at this point. They wanted a piece of the remote revenue, and there were no Amazon warehouses in the state at that time. So they couldn't force anyone to get registered and collect their tax. There was no nexus. So Colorado went a different route, and they said, okay, if I can't force you to get registered, I'm going to make your life so miserable, you're going to want to register voluntarily. And this spent, roughly 7 years in the courts. It went to the U.S. Supreme Court. The U.S. Supreme Court said that this is not a tax. So therefore, they sent it back to the lower court where Judge Gorsuch was the judge. He's now Supreme Court Justice. And he said Colorado could move forward. And what this says is that there's a series of notices that a company has to make, basically saying, we're not collecting the sales tax, so you, purchaser, are responsible for collecting the sales tax. And most of the states who passed this also said you have to turn over a list of your clients who made purchases in our state. In Colorado, the who we thought were out of their mind to begin with, they turned out to be one of the more sane companies because their penalties for non-compliance were relatively small. But then we had companies like Washington and Pennsylvania that had tremendous penalties. By the way, those two states have sunset their notice and reporting requirements. But we've still got to worry about Oklahoma and Puerto Rico. Vermont, their thresholds are they don't have a threshold, but $25 per issue, very small. Puerto Rico, you could have, $400 in sales, one sale each quarter, and you could have, in excess of $25,000 in penalties. We tell a lot of companies, just stop selling in Puerto Rico. I mean, $400 doesn't really, justify the cost of a registration and doing returns. And, on $400 of sales, it's ludicrous to get, 25,000 plus in penalties. So that's a one that you have to look out for. Vermont, not so much. Oklahoma, they say that you have to pay $20,000 or 20% of the revenue in the last 12 months. So if that revenue is only $10,000, you're looking at $2,000, but it's per issue. And there are really 3 issues per transaction in Oklahoma. So it's $6,000 per transaction. In order for you to get to $10,000, I had a company the other day. I mean, this is ludicrous, but they were selling small dollar items. So when we did the number of transactions, which was in the thousands, times $6,000, they had like $365 million potential penalty. Now, the legislature in Oklahoma said for the first 5 years of this, the Department of Revenue has the ability to mitigate some of these penalties. But even if they do 0.5% of 365 million or whatever the number was, that's still a huge number. So, I mean, it's ludicrous. These penalties are draconian. And by the way, they said for 5 years they could mitigate it. This is this coming July of 2023. Their hands are going to be tied. So unless the state does something in Oklahoma, there are some sellers who could potentially have some big issues. Now, I'm sure that if you go to court and fight this, you can win, but going to court isn't cheap, especially when you only have $10,000 in sales and potential 365 million. So what we tell our clients is to be progressive, either do a VDA when your numbers are small, or at the very least get registered prospectively going forward. We don't know if Oklahoma will come after you or not, but it's better than letting that exposure continue to build. I actually like VDAs, even though the exposure is low. So here's a chart that talks about this. This chart is, we're mostly going to sunset it because a lot of the states have done away with this, but you still have to worry about Louisiana, Oklahoma, Puerto Rico, and Vermont. We talked about some of these developing states, a number of the states, but not all, moving away from transaction threshold, and some, but all states are eliminating affiliate or click-through nexus. Not all the states. just some of the states. So when you're advising your clients or when you're looking at your own Nexus footprint and you're looking at economic Nexus, you may have, if you've got these affiliate programs, you got to look at that. So not everything that has a dollar threshold attached to it is economic Nexus. All right, Ellie, why don't we do the next poll question?
Absolutely. That question should be up on everyone's screen right now. The question we have here is, what about sales tax nexus concerns you the most? So your choices are nothing, you have a down, economic nexus, third parties, travel, and other. And Mike, looks like most people are responding with third parties. Leave this open a couple more seconds. Quick reminder, you do have to answer these questions in order to receive CPE. And we will be doing 2 more poll questions probably right at the end here. So why don't we wrap this up and we can move forward, Mike?
All right. So yes, economic nexus is a big one, but perhaps the biggest that most people are fearful of is third parties, because it just doesn't make sense. I mean, we think about our own actions, but we generally don't think about the parties that do work for us. All right. So let's talk a little bit more about third party nexus right now. The activities of third parties create nexus if they're helping to establish or maintain a market. Now, all of these items listed on the screen here, this is just a partial listing, are things that states say help to establish or maintain a market. Rather than go through all of the potential issues there, I'm going to tell you what we tell our clients. If you're sending someone into a state, whether you call them an independent contractor, whether you call them a subcontractor, whether you don't label it at all, whether you just hire someone to go and do something in a state for you, in general, that's going to be a nexus creating activity. They're helping to establish or maintain a market. But it's not all third-party relationships, all right? It's just if they're interacting with the public or with your customers. Let's say that you hire a bookkeeper on a 1099 basis, or someone to develop some software for you. They're not interacting with the public in general or with your clients. So those are generally not going to be nexus creating. So it's not all third-party relationships create nexus for you. It's just the ones where they're interacting with the public. So or your customers. Installations, implementations, training, performance of services, things like that. And by the way, it's not just where they're located, but anywhere they're traveling on your behalf. So anywhere they're helping you to establish or maintain a market. Now, for employees, they don't even have to meet their threshold. Some states say if you've got employees here pretty much for any reason, and some of them say a week, some of them don't say anything, but states like Arizona and Michigan say, hey, if you've got someone here greater than 48 hours cumulatively throughout the year, that's nexus creating. So this also plays into effect if you have employees telecommuting. Now, during the pandemic, a lot of people started telecommuting, and the states put those rules on hold, but they're all, the exemptions or the holds on that, they're all expired. So I think you're going to see going into the new year, if you've got someone working from home in a state where you're not registered, that's going to become a potential issue for you. All right, so inventory creates presence, physical presence nexus in most states. Amazon inventory is an exception in a couple of states, Arizona, Illinois, Texas, and Pennsylvania. These rules have changed since Amazon has started collecting tax. State like Texas says Amazon inventory no longer creates nexus if it's only being used to fulfill Amazon sales. More and more companies are getting Amazon to fulfill all their sales at this point. And if that's the case, that Amazon warehouse still creates nexus. It's only when it's being used to create to fulfill only Amazon sales, that it no longer creates nexus. All right, so this is a big deal nowadays. We have so many people who say, you know, Mike, I don't have this link or connection anywhere you're talking about. I don't have, I've got a virtual office. Well, the states don't believe that. They believe anywhere you live or operate your business from, or where you have employees, that creates a link or connection with the state. All right, so let's talk about marketplace facilitators. Sites like Amazon, eBay, Etsy, Walmart, not platforms like Shopify. I think they're gonna become a marketplace, but right now they're not classified as one. Big commerce, WooCommerce, not marketplaces. However, the way that these marketplace statutes are written, they, your company could actually fall under it if it meets certain criteria. So you got to be comfortable looking at these statutes, or hire someone like us to see if you might be considered an actual marketplace. 46 states and DC now have collection requirements. Missouri is currently pending. In January 1st, it will become live. So if you're only selling through a marketplace, or if your sales outside of the marketplace are small, deregistrations may be what you need to be looking at. Now, if you're doing deregistrations, there are some exceptions. You generally don't want to deregister in your home state. State of Washington, unless you got the small seller exemption, you generally don't want to deregister there because of the business and occupation tax. And the state, Amazon's not paying that to the state of Washington. That's something that's still your responsibility. And states like California, if you've got, your suppliers shipping to California for you, they're going to require an exemption certificate. And you may have to, California, one of those states where you got to be registered there in most circumstances in order to issue a valid resale certificate. So if you're in a state like that, you might want to stay registered also. All right, so deregistration, here's a warning. It's a process that varies between the states. You can't just stop filing. And that's what we're seeing right now. Companies that have just stopped filing thought that that was enough. And now the state's coming after them for months worth of back taxes, and they've got to work with the state to get that all corrected. Here's an even bigger one though. Income tax totally separate from sales tax. If you get deregistered for sales tax, that doesn't mean your income tax responsibilities go away. And, you could still have a requirement to file income tax. All right, so marketplace collection, not always a good thing. Nexus is still created in most states by that Amazon inventory. You need to collect tax for other channels, including potentially income tax because of the inventory. States still pursuing sellers for back tax plus penalty and interest. California, a big example. You could still have filing responsibilities like the Washington business and occupation tax. But perhaps the biggest issue, while this is not always a good thing, states can easily access seller information, and income tax is going to be the next big battle for online sellers. And it's going to start with FBA sellers. California already fired the first shop. Pennsylvania followed up. They got their hands slapped, but they're going back to the drawing board to see how they can do this. But it's not going to stop with the FBA. It's going to spread to all e-commerce. I mean, Massachusetts says Public Law 86-272 is unconstitutional in light of Wayfair. The MTC came out with new guidance saying cookies, emails, or chats exceed the protections, and Oregon created a new gross receipts tax. So the next 18 months or so, 24 months, it's going to be pretty much all out. The beginning of the new income tax battles for online sellers. Here's some of the more aggressive states: California, Pennsylvania. Florida, very aggressive when it comes to C Corps, S Corps, and LLCs. They don't really tax those. Illinois, Puerto Rico, Nebraska, South Carolina automatically open up income tax accounts for you when you get registered for sales tax. Texas, very, very, very aggressive. Kentucky, very aggressive also. So these are not the only aggressive states, but these are the states you need to look out at first. What does the future hold? I think it's a dichotomy. The future looks very bright for marketplace sellers. You don't have to worry about these sales tax that are for sales made through the marketplaces. If you're selling on multiple platforms, you could still have issues. The past is still going to create issues. Anyone else who's not registered going forward, I think it's going to be very ugly. States are going to stumble across you for economic nexus, but they're going to find all types of nexus, and they're going to make examples of companies. States sometimes, make an example out of someone to create fear. They want that person to go out and tell all their friends and competitors, and this way more companies will become compliant. And income tax and similar taxes, I think, are going to be a much bigger issue going forward. Some sales tax policy changes. This is a good resource for that. And Ellie, do we have any questions out there right now?
We do, but I want to throw out a couple more poll questions, Mike, so that people can have their CPE credit. So I'm gonna launch a quick true or false question and then an easy wrap up question here. So quick true or false, you must have physical presence to create Nexus. Quick reminder again, you do have to answer these to get CPE credit. Mike, most people are answering false right away. We're gonna leave this open a couple more seconds and then we will jump right into the next question. So I believe false is the right answer. Is that right, Mike?
Yes, false is the correct answer.
Great. Okay. All right. I'm going to shut this one down and let's go to our last question here. And that last question is, are you ready for the new year? Your answers are yes, no, or wait, it's almost a new year, or choice 4, which is, I guess, other. So thanks for sticking with us here. We really appreciate it. And Mike, a lot of people ready for the new year. Some people just totally blown away like me that it's almost a new year, and fair amount of choice 4s and no's as well. So why don't we give this a couple more seconds and we'll jump right into questions. So I'm going to close this out. And Mike, are you ready for some questions?
I'm ready for some questions.
All right. Okay. What are the most aggressive states conducting audits?
Tough question to answer. I could go with my usual, it depends, but the states with more auditors are generally the most aggressive. So a state like Texas, a state like California, they've got a lot of auditors, and they're not only in their home state, big states like Texas and California, they have auditors spread throughout the country. So sometimes people tell me, well, Mike, someone's not going to fly all the way out here to audit me. I'm just a small company. Well, two things. Number one, they may have someone in your backyard right now. And number two, we're seeing a trend towards remote audits. The pandemic has really changed not only the way that companies do business, but the way states do business also. Some of the other states that are fairly aggressive that don't have as many auditors as New York would be Massachusetts, Pennsylvania, Washington, New York, Florida. All of these are aggressive states. But here's the thing. As we're going into a recession, all of the states are going to become more aggressive. I don't know of a state out there that's not going to become aggressive when they need revenue. So if you're not in one of the states I mentioned, I would not assume that you're safe, because audit activity, discovery activity is going to be going up everywhere.
All right. Thank you so much, Mike. We're just going to move right down the line here. Are third-party nexus and affiliate nexus still effective?
third-party nexus is absolutely effective. It is the biggest issue out there facing companies because we just don't think about third parties creating nexus for us. So in all my time in sales tax, this has always been the biggest issue. And I think it's going to continue to be the biggest issue for a long time to come. And, you know, when an auditor is looking for economic nexus, you may not have any, or you may have it. And I don't know what that answer is, but it's only going to be for 4.5 years. But if you've had an independent contractor making sales for you, or someone doing installations or training for you for the last 10 years, you've got 10 years worth of nexus in most states. So yes, third-party nexus is, I think it's the greatest danger facing companies out there that have this exposure and are not aware of it. Affiliate nexus, on the other hand, a lot of states have sunset that since economic nexus came about. But in a number of states, affiliate nexus is still alive and well. So it depends on the state, on the affiliate nexus part. On the third-party nexus, every state, everywhere.
All right, thank you so much, Mike. Someone asked, what if you're exclusively a web-based service provider?
Here's my favorite answer. It depends. It depends on what your revenues are. So if you're performing services, let's say you're an accountant and you have clients all over the country. In a state like South Dakota, you have more than 200 invoices that go into the state of South Dakota. You probably now have to start charging taxes on your service because the state of South Dakota actually taxes accounting and legal services. State of Hawaii also. So, you know, if you're a web-based service provider, yes, you still could have an exposure in quite a number of states across the country. So wherever that service is, the benefit of that service is being received, you know, depends on how much you're doing. I mean, if you do $6,000 worth of services in a state, probably not a problem. You do 200 transactions, could be an issue. You do $100,000, could be a bigger issue. You do $500,000, could be a much bigger issue. So it depends on what, you know, your service is. Some states don't tax, you know, services, but a lot of states are taxing more and more services. So it really all depends.
All right, thank you so much, Mike. Okay, and let's do, is click-through nexus still in effect?
Yes, that's didn't we just answer that?
We did.
Click-through nexus, yeah, click-through nexus is still in effect in a lot of states. Not all states. Some states have sunset their click-through nexus laws once economic nexus came about, but a lot of states still have it. So you got to see when you're figuring out what your nexus footprint is, if you've actually, you know, crossed the thresholds. There's a dollar threshold associated with most of click-through nexus. Even though there's a dollar threshold, it's considered physical presence, not economic nexus, which is why they go back perhaps all the way to 2008.
All right, and let's.
I see a question up here that I see a question up here I want to answer. It says, does affiliate nexus mean physical presence? And affiliate nexus is a type of physical presence. It doesn't mean physical presence. There are lots of other types of physical presence, but if you have a third party, which is what affiliate means, doing something on your behalf, that could create nexus for you. And also, if you're talking about affiliate programs, that's a type of physical presence also. So affiliate nexus doesn't mean physical presence or physical nexus, but it is a type. No matter which definition you're looking at, it is a type of physical presence nexus.
All right, let's close it out there and let's.
Okay, I see another one. I may have misheard this. It says, are the states still enforcing notice and reporting? I might have misheard that as another question and answered the wrong question. But yes, some states are still enforcing notice and reporting. The ones that we talked about were Vermont, Puerto Rico, Oklahoma, and Louisiana. Those are the four that I would worry about. And Vermont, not so much. There aren't very many there. The teeth aren't very big in the Vermont notice and reporting. But the other three, yeah, I would make sure that I'm not subject to the notice and reporting requirements, especially Oklahoma. The rest of them have mostly sunset their laws since economic nexus came into play.
All right, thank you, Mike. Anything else you want to answer here?
I want to add to this, by the way, if you're doing a VDA in the state of Washington, they make you sign extra paperwork because of the notice and reporting, but they will waive all of those requirements when you're doing a VDA.
All right, thank you so much. And why don't we wrap it up here, Mike? And again, if you see anything else here, we can jump right into it. But I want to thank everyone for joining us today and for coming to our webinars in general. If you've been here in the past, we will be finishing out our new series in the new year, so keep an eye out for that. And we hope that if you need any last minute help, please reach out to us. We'd love to work with you. And otherwise, we'll be here in the new year. Anything else you want to add in here, Mike?
Yeah, I want to answer one more. It says Louisiana doesn't offer remote seller VDA program yet. They do offer a VDA that you can do through the jurisdictional local parish websites, and you just check all of the parishes that you want to do the VDA in. So if you have exposure in the local parishes and you don't want it to continue, then you can go parish by parish. It's a single form that you fill out and you just check the VDAs that you want and you do the state VDA. We have a number of clients who have done that, especially one had a big tax collected not reported issue. They were working with one of the software companies who collected all those local taxes and never remitted them. So they had over $1 million program spread out amongst the parishes. So that's was a great solution for us, was the multi-parish VDA, and then the state, they didn't have any issues. So that's all we had to deal with. Other than that, I thank everyone for joining us today, and I wish everybody happy holidays. And hopefully you all have a great start to the new year. Thank you, everyone. Bye-bye.